Index funds, ETFs, and mutual funds. They sound similar, they look similar, but they're not the same, and choosing the wrong one could cost you thousands. In the next 10 minutes, I'll show you the difference and help you pick the best one for your money. Index funds, ETFs, and mutual funds. They sound similar, they look similar, but they're not the same. And choosing the wrong one could cost you thousands. In the next 10 minutes, I'll show you the difference and help you pick the best one for your money. Let's start with the basics. What is an index fund? Let's start with index funds. An index fund is a type of mutual fund or ETF that tracks a specific market index. Think of it like a basket. The S&P 500 index fund holds all 500 companies in the S&P 500. You buy the basket, and you own a tiny piece of every company. Popular S&P 500 index funds include V, OOV, FIAX, and FXAIX. They all track the same index. The only difference is how you buy them. Index funds are incredibly cheap. Expense ratios can be as low as 0.03%. That's $3 for every $10,000 invested. They're passively managed. No fund manager is trying to beat the market. They just track the index. That's why fees are so low. And here's the kicker. Over long periods, index funds outperform most actively managed funds because low fees and consistent tracking win over time. You can buy index funds as mutual funds or ETFs. Vanguard, Fidelity, and Schwab are the best places to buy them. So that's index funds. Low cost, passive. They track the market. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. They're very similar to index funds, but with one big difference. They trade like stocks. You can buy and sell ETFs throughout the day, just like stocks. The price changes every second. You can trade at 10 a.m. or 2 p.m. Popular ETFs include VOO for the S&P 500, VTI for the total U.S. market, QQQ for the NASDAQ, and BND for total bonds. Most brokerages now offer fractional shares. So if VOO costs $500 a share, you can buy $50 worth. You don't need to buy full shares. ETFs have the same low expense ratios as index funds. VOO has an expense ratio of 0.03%, same as the mutual fund version. ETFs are usually more tax efficient than mutual funds. Because of how they're structured, they generate fewer capital gains distributions. You can buy ETFs at any brokerage. Vanguard, Fidelity, Schwab, Robinhood, all of them offer commission-free ETF trading. So that's ETFs. They trade like stocks, low cost, tax efficient. Now let's talk about mutual funds. This is the oldest type of investment fund. They've been around for decades. Mutual funds pool money from many investors to buy a portfolio of stocks, bonds, or other securities. You buy shares directly from the fund company. There are two types: actively managed mutual funds, where a manager picks stocks, and index mutual funds, which track an index, just like index funds. Actively managed mutual funds are expensive. Fees can be 1% or more. Index mutual funds are cheap, with fees as low as 0.03%. Mutual funds trade differently. You can only buy or sell at the end of the day. Everyone gets the same price. No intraday trading. Many mutual funds have minimum investments. $1,000, $2,000, sometimes $3,000. That can be a barrier for beginners. The advantage? Mutual funds make automatic investing easy. You can set up $100 a month to buy automatically. Great, $4 cost averaging. So that's mutual funds. Trade once, daily, possible minimums. Great for automatic investing. Now, let's compare them directly. directly. Here are the 4 most important differences: fees, trading, minimums, and taxes. First, fees. Index funds and ETFs have the lowest fees. Actively managed mutual funds have the highest. Always choose low-cost options. Second, trading. ETFs trade anytime during market hours. Mutual funds trade once per day after market close. For long-term investors, this doesn't matter much. Third, minimums. ETFs have no minimum beyond the share price, and with fractional shares, you can buy $1 worth. Mutual funds often have $1,000, $3,000 minimums. Fourth, taxes. ETFs and index funds are tax efficient. Actively managed mutual funds generate more capital gains distributions, which means more taxes. So here's the comparison. Index funds and ETFs are very similar. Low fees, low taxes. Mutual funds can be good or bad, depending on whether they're active or passive. One clear takeaway: avoid actively managed mutual funds with high fees. Most don't beat the market, and the fees eat into your returns. But passive mutual funds that track indexes are great. They have the same low fees as The FX is a mutual fund version of VOO. Same thing, different wrapper. For taxable accounts, ETFs are usually best because they're more tax efficient. For retirement accounts like IRAs, it doesn't matter as much. So, the winners for most investors are ETFs and index funds. Low fees, tax efficiency, no minimums. Now, let's decide which is best for you. So which one is best for you? It depends on your situation. Let me give you 3 simple recommendations. Scenario 1. You want simplicity and automatic investing. Use index mutual funds. They're easy to automate. Set up $500 a month and forget it. Scenario 2. You want flexibility and low minimums. Use exchange-traded funds. You can buy $1 worth. You can trade anytime. Perfect for beginners. Scenario 3. You have a retirement account, like an IRA or 401k. Either works. Just choose low-cost options, VOO or VFISX. Both are great. For most beginners, I recommend starting with exchange-traded funds. They're flexible, they have no minimums, and you can buy fractional shares. The bottom line: both ETFs and index funds are excellent choices. Use ETFs for flexibility. Use index mutual funds for automation. Just avoid expensive, active mutual funds. Let's quickly recap. Index funds track an index and have low costs. ETFs trade like stocks and are tax efficient. Mutual funds are great for automatic investing. Here's your action plan. Open a brokerage account. Choose ETFs or index funds. Start investing today. Even $50 a month makes a difference. And remember, this video is for educational purposes. I'm not a financial advisor. Your situation is unique. Talk to a professional if you need personalized advice. I'm Mr. Mint, and I'll see you in the next video. Remember, your future self will thank you for the investments you make today. Start now. You've got this.